Wall Street now owns over 450,000 single-family homes across the U.S. You've seen the headlines. They're buying up everything. They're driving up prices, and they're locking out buyers. But that's not the full story. The reality is that millions of small investors, mom and pops, just like me, are quietly buying up homes as well. So today on The Housing Nerd, we're going to break down the numbers and take a look at who actually is buying all the homes in the U.S. And by the end of this video, I'll take you under the hood of one of my duplex deals and break down exactly why so many mom and pop investors have got into real estate and how deals like this can either build serious income or turn into a financial mess if you don't know what you're doing. I think you're really going to enjoy today's Housing Nerd video. Now, if you're new to my channel, welcome. My name is Jason Ferrier. I am the Housing Nerd. I've been a realtor and investor in Central Ohio for the last 7.5 years. And I really want to know your thoughts on investors in general in the housing market, both big and small. So drop your thoughts in the comments below. Now, to kick things off, we're going to take a look at the Government Accountability Office report on rental housing and institutional investment. According to the recent study by the GAO, no single investor owned more than 1,000 single-family homes prior to 2011. However, by 2015, institutional investors owned between 170,000 and 300,000 homes. By 2022, 32 institutional investors collectively owned over 450,000 single-family homes. And according to the GAO, the 5 largest investors, are you ready for this? Owned nearly 300,000 of those 450,000 homes. And by the way, the link to all this material today is in the description below, as always. So what they're saying here is basically before the GFC, institutional investors really were nothing to write home about. I mean, there was not one investor that owned over 1,000 homes. Are you surprised by that? Comment below. Now, just for a minute, let's look at the rise of institutional investing, kind of how it all got started. The Government Accountability Office attributes the initial growth of large institutional investors in single-family rental housing to bulk purchases facilitated by local auctions of foreclosed properties after the 2007 through 2009 recession. Large investors had an advantage over small investors and individual buyers in that they had access to cash and could leverage other sources of capital more easily. Fannie Mae and Freddie Mac, 2 government-sponsored enterprises overseen by the Federal Housing Finance Agency, also contributed to this growth to some extent. Fannie Mae's REO to Rental Initiative pilot program, which allowed pre-qualified investors to bid on large portfolios of foreclosed properties, was launched in 2012 to help stabilize the housing market. Roughly 2,500 properties were sold. In 2017, Fannie Mae backed a $1 billion loan to Invitation Homes, one of the largest investors in single-family homes. And Freddie Mac provided $1.3 billion in loans to the institutional buying market. The FHFA terminated both programs in 2018. But now let's take a second and look at how many homes they actually own now. What is the actual share of institutional investors in the single-family housing market? And this report is from 2023, so keep that in mind. But they say, while institutional investors own roughly 2% of the single-family rental housing stock across the U.S., they own a much greater share of homes in certain markets, particularly in the Southeast. The GAO estimates that the institutional investors own 25% of Atlanta, Georgia's single-family rental housing stock. Wow. 21% of Jacksonville's, 18% of Charlotte's, and 15% of Tampa's. Areas that experienced the greatest influx of institutional investment after 2007 through 2009 recession continue to have high rates of institutional investments in single-family rental markets. And that makes sense, right? Like if you bought a home, an investment property back in 2007, 2009, I mean, that thing is probably cash flowing like you wouldn't believe right now. Comment below. Tell me, do you own a home from 2007, 2009, 2010? Did you buy something then? Do you own a rental? Sure, if you bought one during that period of time, I'm sure it's cash flowing, probably paid off by now. Also, what do you think about the 2% number? I mean, they say, while institutional investors roughly own 2% of the single-family rental housing stock across the U.S. So according to the GAO and their study from 2023, the market share of institutional investors, those that own over 1,000 homes, only 2%. Now, many people think that's false. They think that data is cooked, it's manipulated, it's probably full of fraud, greed, and corruption. Tell me what you think. To further illustrate the share of homes that institutional buyers actually are controlling, I'm pulling up an article now from HousingWire. And the title of this article is, No, Wall Street Investors Are Not Buying Up a Bunch of Homes. Now, Logan Montashami wrote this article and he says, despite what you see on social media, this housing market myth is easily disproved. According to the article, just a year ago, a striking claim circulated that Wall Street investors had bought 44% of all homes in America in 2023. This kind of sensational story can easily lead to misconceptions about housing economics. Fast forward to today, and the trend has shifted to the idea that BlackRock is snapping up homes left and right. However, a closer look reveals that it's Blackstone, not BlackRock, driving these purchases, and they aren't acquiring nearly as many properties as some might think. And HousingWire is quoting some data from John Burns Real Estate Consulting, and this pie chart shows the total single-family housing stock at 105 million units, Blackstone owning 0.06% of that inventory, and other institutionally owned single-family rental holdings equals 0.5% or 0.5%. So according to John Burns Real Estate and HousingWire, they're saying institutional investors don't even own 1% of the single-family rental stock. Comment. Tell me what you think. And he goes on to say, are big Wall Street investors really buying 44% of homes this year? The answer is no, not even close. And remember, this was written in December 10th of 2023. Housing inventory is near all-time lows, but big institutional investors like Invitation Homes or BlackRock aren't to blame. The 44% claim was made in the headline for a Medium article last week and then spread like wildfire all over social media. Congress even jumped on the bandwagon with Democratic lawmakers introducing bills looking to limit or ban hedge funds from buying single-family homes. So big question. It's a big debate. Comment below. I want to know what you think. Should we ban institutional or hedge fund buyers in the housing market? Now, as you and I both know, you flash forward to today from 2023, have we actually banned big institutional buyers? No, we haven't. Do you think they'll be banned under the current administration in the White House? Tell me what you think. The purchase market share overall for investors, you're nearly at 30% of all homes going to some investor when you look at purchases, not historically what people have owned. So there's a big delta there. If you're looking at 30% of all homes purchased go to investors, and you're looking at, let's call it and be generous to institutional investors and call it 5%, think about that. You've got a 25% share that are going to small mom and pop investors. Comment below. Does that surprise you? In fact, when you look further into the details of this with John Burns Consulting info, you can really see how all this kind of materializes and the picture becomes a lot more clear. And I want you to pay attention to the right side of this chart. So the first column here is the total purchase volume in 2023 for quarter two. And then the second column is the percentage of total purchases 2023 quarter two. So let's first look at iBuyers. That's like Open Door, Zillow, that type of company. In quarter two of 2023, iBuyers purchased 3,070 homes. That was 0.5% of all homes purchased that quarter. But then you've got the institutional investors that are buy and hold, buy and rent. The iBuyers are more like buy and sell, buy and flip, right? So the tier 4 investors, those that own 1,000 or more properties, 1,959 total purchases in that quarter, or 0.3% of all homes sold. Tier 3 investors, 100 to 999 properties. They bought 4,692 homes, or 0.7% of all homes that were sold in that quarter. Tier 2 investors, 10 to 99 properties. That was 16,928 total home purchases in that quarter. 16,000, call it 17,000 homes. And that was 2.7% of the total home purchase market share in that quarter. And then you've got tier 1 investors, those that own 1 to 9 properties. They bought 125,000 homes, or about 20% of total purchases went to those investors. I thought this was one of the better infographics we could look at to understand really what investor is buying what percentage of homes. This surprised me. Does it surprise you? The viral story saying Wall Street has bought 44% of the single-family homes this year is laughable, according to Logan. The 1,000 plus block buyers accounted for just 0.4% of market share in Q2 2023. And we know that these large investors have dialed back the number of homes they're purchasing. I actually just made a video about the fact that they've shifted to build to rent, where they're just building homes now to rent them out rather than buying existing homes. The article concludes, to make a long, convoluted story very simple, there is nothing in the data to show that Wall Street has been a big buyer of homes in the U.S. since 2000. I would argue against that. I don't know what you think, but they obviously have been a big buyer. Maybe not as much as, the narrative is out there, but they certainly are a big buyer. I mean, if you own over 1,000 homes, I kind of consider you big. If you want to pin the blame on someone, you're going to have to condemn those avocado toast eating kids, the millennials, who started buying homes in 2013 and were the largest percentage of home buyers until mortgage rates rose in 2022. Did you know that? Did you know that millennials are the largest percentage of home buyers since 2013 up to 2022? Comment below. I didn't know that. Since then, Gen Xers and baby boomers have had once again come out on top, according to the National Association of Realtors. Either way, it's not Wall Street, but that isn't a sexy talking point in the class warfare dialogue. To further illustrate this mom and pop investor phenomenon and misunderstanding, I'm looking at a recent article from Cotality, used to be CoreLogic. And they say, while there's a large focus on institutional investors, mom and pop investors actually make up 60% of the investor purchases. There is no MSA in the top 20 or metro where mega investors make up more than 5% of purchases. Los Angeles has garnered significant interest from investors recently, has the highest total investor share in the US with 42% of purchases transacted by an investor. However, only 2% of purchases were made by mega investors in 2024. And then they show us, and this is really powerful, this shows us different metros and cities, and then the percentage of what type of investor bought how many homes. So take a look at this chart and tell me what you think about it, because maybe you live near one of these metros, maybe you agree with the data, maybe you don't. For instance, in Houston, Texas, small investors made up little over 20% of all home purchases in 2024. And those investors own less than 10 properties. Then you got medium investors, those that own between 10 and 100 properties. They made up 6.5% of all purchases. And then large investors, those that own between 100 and 1,000 properties, they made up 1.47%. And then finally, mega investors made up in Houston just 1.29% of all home purchases in 2024. So it looks like the greatest share of small investors, mom and pop size, was in Los Angeles based on this data at 25%. Then you had Las Vegas, Nevada at 23%, 24%. You had Seattle, Washington at 21%, 22%. Austin, Texas at 18%, 19%. Minneapolis at 16%. But I'm really curious what you think about that data, because again, a lot of people assume that these large institutional investors own all the market share, when in reality, it's just your next door neighbor. It's your cousin. It could also be a family member or somebody you know that simply bought a home from a relative out of an estate when they passed away. I mean, that happens a lot. I know in my generation, Gen X, it's happening all the time. Obviously, people get old, they pass away. My father's getting old. At some point, he will pass away. And when he does, he's probably going to leave his home to myself and my siblings. But let me show you why tons of other mom and pop investors like me really like real estate. This is a quick video of one of the duplexes I've purchased over the past few years. Now, I paid about $120,000 for the property. It's a duplex, 3 beds on each side, 1 bath on each side. It's an old property built around 1910. Now, for the down payment, I put down $24,000 or 20%. Plus, I had about $3,000 in closing costs. So all in, 27 grand out of my pocket so far. But then after I purchased the property, I obviously had to do some repairs. To get the renovation done, I borrowed money from a private lender. You may know this, you may not, but there are tons of folks out there that are willing to loan money to good real estate investors who have a plan. And by the way, none of this is investment advice. I'm not an investment advisor. I'm not a certified investment planner or anything to that nature. I'm a realtor. I'm an investor, and I'm just sharing some of the things I've done. So the loan was $30,000 for the renovation. Now on my primary mortgage, which was $96,000 after the down payment, I'm paying at a 7% interest rate. I'm also paying 7% on the renovation loan. And so monthly, my total expenses look something like this: $639 for my mortgage payment, about $200 a month for the repair loan, my taxes, around $200 to $250 a month, my insurance, about $100 to $150 a month. So total expenses, roughly $1,139. As far as the rental income goes, I rent each side for $1,300. So that's a total of $2,600. So my cash flow is about $1,400 a month. So I bought the property for $120,000. After I made the repairs and waited a few years, I had the property reappraised, and it appraised for $240,000. My loan balance right now is about $120,000. And so my total equity, about $119,000. But my cash flow at $1,400 a month is really nice to have. But stick with me, because it's not just roses and rainbows and unicorns with this stuff. But let's go back to the cash flow for a minute, because this is where the big opportunity is for a lot of people out there wanting to buy their first home, maybe even their first investment property. If you can buy a duplex, a triplex, or a quad and live in one unit and rent out the others, in other words, house hack it, you can be light years ahead of most other folks who are out there struggling and scratching their heads trying to figure out, how do I buy my first house? Because most people want a 3-bedroom, 2-bath, 2,000, 2,500 square foot home that's all renovated, new flooring, new paint, new drywall, everything blinged out. And they're expecting to get that property for a discount, which lately hasn't been very easy to find. If you were to take that same duplex at the same price, you pay $120,000. Now you can't rent out both sides of the property, so you're only going to get $1,300 a month. And your expenses, $1,139. So your net cash flow, approximately $160, which isn't much. However, you see what this does? Basically allows me to live for free. Why? Well, because the other side of the property is paying all that for me. And so I'm gaining equity with the renter on the second side paying my mortgage every month, and while I get to live and not have to rent. And because it's a residential property, it comes with a lot of benefits that commercial properties don't carry, especially with financing. But remember, I told you before, it's not all rainbows and sunshine being a small landlord. You can certainly get creamed if you're not careful. Here are the things I'd watch out for. Underestimating rehab cost has to be number one on the list, like a roof, wiring, plumbing. Forget the cosmetic stuff, just the main parts, the guts of the home. Heating, air conditioning, all that has to be thought of. So you got to do a lot of inspections. You got to do your due diligence and really understand rehab costs before you dive into something like this. Also, I didn't include in my cash flow analysis the maintenance cost ongoing with the property. And those can be anywhere from 10 to 20% a month. And so that's, $200 to $400 per month I have to plan just for the stuff that breaks, especially being an old house. The vacancy risk is another thing you got to watch out for, because it's not as easy as you think to get a tenant into a rental property. There's a lot of process with it. There's a lot of procedures with it. Now, you can hire a property manager, but that does cost money. So whether you do it yourself or even find a property manager, there is risk to having the unit vacant. The other thing to look out for are unexpected expenses like increased property taxes and definitely increased insurance costs. Also need to be careful about over leveraging yourself. I took out a loan in order to do some repairs, but no doubt there are a lot of smaller investors, even big investors, that get over leveraged, mainly because they don't plan out the expenses correctly. So they get in over their head with expenses. They underestimate how much things cost to actually repair. And guess what? They get creamed. The market could also shift. I mean, what happens if all of a sudden there's a bunch of job loss in the area and you can't find tenants? For me, I like to invest in areas where they need affordable, good housing and where I can charge below market rent and still cash flow like I gave you in the example today. I usually like to plan for worst case scenario. So when I have a duplex, as a landlord, I like to plan out that if I can only rent one side for the entire year, will I actually still be able to cover all my expenses and the mortgage payment? If I can, that helps me make the deal work. And whatever you do, don't bank on rent increases year after year like we've seen recently, or even at all. Because if rent doesn't continue to go up and it has to come down a little bit, you need to be prepared for that. Now, having said that, again, I'm not a financial advisor. I'm just a realtor. I'm an investor, but I believe in real estate for the long term. Now, if you enjoyed today's video, do me a favor, hit the like button and subscribe to The Housing Nerd. And YouTube thinks you'll like this next video from me right here.